Bitcoin halving is a programmed event in Bitcoin's code that halves the reward miners receive for validating transactions, occurring approximately every 4 years or 210,000 blocks. This mechanism, designed to control inflation and mimic scarcity like gold, caps Bitcoin's total supply at 21 million coins. According to Bitcoin's white paper by Satoshi Nakamoto, this ensures a predictable issuance schedule, with halvings reducing new supply and potentially boosting value if demand remains steady or grows. Tish Video Key Points. Research suggests that Bitcoin halvings, which reduce mining rewards by half every 4 years, create supply scarcity that has historically contributed to price increases, though the effect diminishes over time due to market maturation. It seems likely that while halvings act as catalysts for bull runs, external factors like institutional adoption, macroeconomic conditions, and regulatory changes play increasingly significant roles in price dynamics. The evidence leans toward positive long-term price impacts from halvings, with average post-halving gains exceeding 2,000% across cycles, but short-term volatility and no guaranteed outcomes highlight the speculative nature of Bitcoin investments. Historical price impacts. Halvings have preceded major price rallies. 2012 halving. Price rose from around $12 to over $1,000 within a year, a gain of about 8,158%. 2016 halving. From $650 to nearly $20,000, approximately 2,023% increase. 2020 halving. From $8,572 to $69,000, roughly 705% growth. 2024 halving. Occurred at about $64,000. Price peaked at $126,198 in 2025 before correcting to around $67,000 in early 2026, showing a 31% initial gain, but overall cycle volatility. Mechanism of price influence. Halvings reduce the rate of new Bitcoin entering circulation, creating a supply shock. If demand holds, prices tend to rise. However, market maturity means diminishing returns. Earlier cycles saw explosive gains, while recent ones are moderated by larger market caps and institutional involvement. Post-2024 halving insights. The 2024 halving coincided with spot Bitcoin ETF approvals, driving initial enthusiasm. Prices surged to $126,000 in 2025 amid institutional inflows, but 2025 closed with a 6% return, the first negative post-halving year, due to ETF outflows, higher interest rates, and risk-off sentiment. In 2026, prices hover around $67,000, down 45–50% from the peak, suggesting a correction phase rather than a new bull run yet. Risks and considerations. While halvings historically boost prices, they don't guarantee gains. Factors like economic downturns, regulatory hurdles, or reduced miner profitability can lead to short-term declines. Investors should view halvings as part of broader market cycles, not isolated events. Advice for investors. For those considering Bitcoin, focus on long-term holding rather than timing halvings perfectly. Use dollar-cost averaging to mitigate volatility and allocate only what you can afford to lose, given Bitcoin's speculative nature. Bitcoin halving is a pivotal event embedded in Bitcoin's protocol, designed to control the cryptocurrency's supply and mimic the scarcity of precious metals like gold. Occurring approximately every 4 years, or after 210,000 blocks are mined, the halving reduces the reward that miners receive for validating transactions and adding new blocks to the blockchain. This mechanism not only slows the rate at which new Bitcoins are introduced into circulation, but also plays a significant role in influencing Bitcoin's price dynamics over time. For investors and enthusiasts alike, understanding the halving's impact on price is crucial, as it has historically been associated with periods of substantial volatility and growth. To fully appreciate the halving's effects, it's essential to start with the fundamentals. Bitcoin's total supply is capped at 21 million coins, a limit set by its pseudonymous creator, Satoshi Nakamoto, in the original white paper published in 2008. According to the Bitcoin white paper on bitcoin.org, the supply is limited to 21 million to prevent inflation and ensure scarcity. The halving ensures that this supply is released gradually, with the reward starting at 50 BTC per block in 2009 and halving periodically. As of the most recent halving in April 2024, the reward stands at 3.125 BTC per block, meaning fewer new Bitcoins are minted daily, which can create upward pressure on prices if demand remains constant or increases. The halving's impact on price stems primarily from basic economic principles of supply and demand. By reducing the influx of new bitcoins, the event creates a supply shock that, in theory, should drive prices higher as the asset becomes scarcer. However, the reality is more nuanced, influenced by market sentiment, investor behavior, macroeconomic factors, and external events. Historical data shows that while halvings have often preceded bull runs, the magnitude of price increases has diminished with each cycle, reflecting Bitcoin's growing market maturity and larger capitalization. According to Investopedia's analysis of Bitcoin halving, the event increases scarcity, potentially driving demand and price, but outcomes are uncertain due to market evolution. In the sections that follow, we'll explore the halving's mechanics in depth, examine its historical impacts on price through detailed case studies of past events, analyze the underlying reasons for these effects, and discuss the specific outcomes following the 2024 halving. We'll also look ahead to potential future implications, including risks and investment strategies. This comprehensive breakdown aims to provide a clear, evidence-based understanding, drawing from reputable sources to ensure accuracy. Understanding Bitcoin halving, the basics and mechanics. At its core, Bitcoin halving is a deflationary mechanism built into the cryptocurrency's code to control its issuance rate and prevent unlimited supply, which could lead to inflation similar to fiat currencies. Every 210,000 blocks, roughly 4 years, the block reward, which is the amount of new Bitcoin miners earn for solving complex mathematical puzzles and securing the network, is cut in half. This process continues until the last Bitcoin is mined, expected around the year 2140, when the total supply reaches 21 million. The halving serves multiple purposes. First, it ensures a predictable and decreasing supply schedule, making Bitcoin a hard asset with built-in scarcity. Unlike gold, where new discoveries can increase supply, Bitcoin's supply is fixed and transparent. According to CoinDesk's explanation of Bitcoin halving, this event reinforces scarcity, potentially driving up price by reducing new supply. Second, it incentivizes miners through transaction fees as block rewards diminish, shifting the network's security model over time. For price impact, the key is the supply reduction. Pre-halving, miners might sell more to cover costs, but post-halving, the reduced reward means fewer new coins enter the market, which can support higher prices if demand persists. To illustrate for beginners, consider a simple analogy. Imagine a factory producing 100 widgets daily. If production halves to 50 while demand stays the same, the price per widget likely rises to balance the market. Similarly, halving cuts daily new Bitcoin production from about 900 BTC pre-2024 to 450 post-halving, potentially boosting value. However, demand isn't static. It fluctuates with adoption, regulation, and economic conditions. According to Kraken's Learn section on Bitcoin halving history, halvings reduce supply, leading to price trends observable in past events. The halving also affects miners' profitability. With lower rewards, less efficient miners may exit, reducing network hash rate temporarily until difficulty adjusts. This miner capitulation can cause short-term price dips as exiting miners sell holdings. But historically, the network recovers and price follows upward. In 2026, 2 years post-2024 halving, we're seeing this play out with prices at $67,000 after a peak of $126,000 in 2025, reflecting both the supply shock and market corrections. According to Fidelity Digital Assets' 2024 Bitcoin halving 1 year later report, 1 year post-halving, Bitcoin's price performance was muted compared to past cycles, but fundamentals stronger. Understanding this mechanic is foundational. Next, we'll examine how it has historically influenced prices. Have you ever wondered why Bitcoin's price seems to explode every 4 years? Comment your guesses below, and for more in-depth breakdowns like this, like, subscribe, and comment Joseph Markets to get 100% fact-checked finance insights. Historical overview of Bitcoin. Halvings and price impacts. Bitcoin's halvings have occurred 4 times since its inception, each marking a significant milestone in its market cycles. These events provide a wealth of data for analyzing price impacts, showing a pattern of pre-halving anticipation, post-halving volatility, and often substantial long-term gains. However, as the market matures, the effects appear to be diminishing in intensity, with earlier halvings yielding more explosive returns due to smaller market caps and higher speculation. The first halving in November 2012 reduced the reward from 50 to 25 BTC when Bitcoin was priced at about $12. In the year following, prices surged to over $1,000, a gain of approximately 8,158%. This massive increase was driven by early adoption and media hype, as Bitcoin transitioned from a niche experiment to a recognized asset. According to BitPay's analysis of past BTC halvings, the 2012 halving saw Bitcoin's price rise from $13 to a peak of $1.52, an 8,777% gain. The supply shock was profound in a small market, leading to rapid appreciation. The second halving in July 2016 cut the reward to 12.5 BTC, with Bitcoin at around 664. Post-halving, prices climbed to nearly $20,000 by December 2017, a 2,576% increase. This cycle was fueled by the ICO boom and growing retail interest, amplifying the halving's scarcity effect. However, it also highlighted volatility, with a subsequent 84% correction in 2018. According to the same BitPay report, the 2016 halving led to a peak of $17,760 from $664 at halving. The third halving in May 2020 reduced rewards to 6.25 BTC, occurring amid the COVID-19 pandemic when Bitcoin was at $9,134. Despite initial economic uncertainty, prices soared to $69,000 in November 2021, a 594% gain, driven by institutional adoption and stimulus-fueled liquidity. The cycle peaked 18 months post-halving, followed by a 77% drop in 2022. According to BitPay, the 2020 halving saw prices from $9,734 to a peak of $67,549. The fourth halving in April 2024 halved rewards to 3.125 BTC, with Bitcoin at approximately $64,000. Unlike previous cycles, this one coincided with spot Bitcoin ETF approvals, leading to a surge to $126,198 in October 2025, a 97% gain from halving price. However, by February 2026, prices have corrected to $67,000, down 45% from the peak, marking 2025 as the first negative post-halving year with a 6% return. According to CoinTracker's Bitcoin price history, post-2024 halving, prices extended beyond $126,000 in 2025 before correcting. This suggests maturing markets dampen halving effects, with external factors like ETF outflows and interest rates playing larger roles. Overall, halvings have contributed to an average post-halving gain of over 2,000% across cycles, but with diminishing returns: 8,177% in 2012, 2,576% in 2016, 594% in 2020, and a more modest cycle in 2024-2025. According to VanEck's Bitcoin Halving Explained, past halvings show explosive gains 180 days post-event, with percentages like 1,091% for 2012. These patterns underscore the halving's role as a catalyst, but not the sole driver of price. The economic mechanism: how halving affects supply and demand. The halving's price impact is rooted in economics. It creates a sudden reduction in new supply, which, if demand is stable or rising, leads to higher prices. Pre-halving, miners receive more BTC, often selling to cover costs, increasing supply pressure. Post-halving, with half the reward, new supply halves, from 900 BTC daily pre-2024 to 450, tightening the market. This scarcity can attract investors seeking digital gold. According to The Guardian's article on Bitcoin halving, halving reduces supply, which in theory increases price if demand stable. Demand dynamics amplify this. Halvings generate hype, drawing retail and institutional buyers. For instance, the 2024 halving aligned with ETF launches, boosting demand despite initial miner sales. However, if demand falls, due to recessions or regulations, the supply cut may not lift prices immediately. According to Science Direct's study on halving events, Attention-driven buying often leads to negative short-term returns, with CAR of 7.55% around halvings. Miner behavior is key. Post-halving, profitability drops, leading to capitulation where inefficient miners sell or shut down, temporarily increasing supply and hash rate drops. But the network adjusts difficulty, and survivors benefit from higher prices. In 2026, hash rate remains near highs despite the correction, indicating resilience. According to Kraken's Bitcoin halving history, halvings can lead to volatility from minor adjustments. Broader factors. Macro conditions like low interest rates post-2020 fueled gains, while higher rates in 2025-2026 contributed to the pullback. According to Trending Topics post-ATH crash analysis, Bitcoin's 50% drop in 2026 follows historical patterns but influenced by macro headwinds. For long-term, halvings reinforce Bitcoin's deflationary narrative, supporting price appreciation as adoption grows. Post-2024, halving, price performance and lessons learned. The 2024 halving at block 840,000 reduced rewards to 3,125 BTC when Bitcoin was at $63,151. Initial response was positive, with prices rising to $68,000 amid ETF inflows. By 2025, institutional demand pushed it to $126,198 in October, a 97% gain from halving. However, 2025 closed negative at 6%, the first such post-halving year, due to ETF outflows of $8.5 billion and risk-off sentiment. According to Yahoo Finance's Bitcoin Records, first-ever negative post-halving year, 2025, saw a 6% decline. In early 2026, prices at $67,000 reflect a 45% correction from the peak, aligning with historical post-peak crashes of 70-80%. According to Trending Topics, Bitcoin fell 50% from $126,198 in ATH in Oct 2025 to $67,000 in Feb 2026. This suggests the cycle is extending, with consolidation rather than immediate bull. Lessons. Halvings don't guarantee instant gains. Market maturity means slower, more sustained growth. According to Fidelity Digital Assets, 1 year post-2024 halving, price was muted at 31% gain but fundamentals stronger. For investors, this phase offers accumulation opportunities. Predictions and future impacts of halvings on Bitcoin price. Future halvings like 2028's will further reduce rewards to 1.5625 BTC, intensifying scarcity. Predictions for 2026-2028 vary. Bullish views see $180,000 to $220,000 by end 2026 if cuts resume, based on 18-month post-halving peaks. From X post by Healthy Living Now, Bitcoin target $180,000 to $220,000 end 2026, peaking Q1-Q2 2026. Bearish scenarios warn of $50,000 if macro worsens. Long-term, as rewards near zero, fees will sustain miners, and Bitcoin may stabilize as a store of value. According to Bitcoin Magazine, by 2028, cycles may lose influence as market matures. Diminishing returns suggest future gains of 200 to 500%, less than early cycles. According to Caleb and Brown's Bitcoin market cycle, halvings drive increases but with maturing effects. Risks and criticisms of relying on halving for price predictions. Halvings aren't foolproof. The 2024 cycle's negative 2025 challenges the narrative. Risks include regulatory crackdowns, economic recessions, or technological shifts like quantum computing. According to DL News, Bitcoin could fall to $10,000 if bubble bursts. Criticisms. Past performance doesn't predict future. Attention-driven hype can lead to bubbles. According to Science Direct, halvings often result in negative returns due to investor attention. Diversify and research beyond halvings. Investment strategies around Bitcoin. Halvings. For strategies, use DCA pre-halving to build positions. Post-halving, hold through volatility. Allocate 1 to 5% of portfolio. According to The Motley Fool, long-term investors see halvings as opportunities. Monitor indicators like hash rate and ETF flows. Avoid leverage. Focus on fundamentals. The broader economic and market context, halvings interact with macros. Low rates post-2020 boosted gains. High rates in 2025-2026 caused corrections. According to Crypto.com, halvings thrive in easy money environments. Geopolitics and adoption influence too. Common myths and misconceptions about halving impacts. Myth: halving always causes immediate price spikes. Reality: gains often delayed. Myth: halving guarantees profits. Reality: speculative. According to The Guardian, halvings reduce supply, but price depends on demand. Conclusion: what halvings mean for Bitcoin's future price. Halvings remain key to Bitcoin's price story, driving scarcity and cycles. While impacts soften, they support long-term growth.